the business end of the deal, couple of quick business questions. Dave, what up, Dave? If you move from a sole trader to a trust, do you need a business valuation, and will it trigger tax issues? Look, you could probably ask that question if we move from a sole trader to a company trust or a unit trust. We're restructuring the business. I'm going to shut up now because I know enough to be dangerous, but surely there'd be some type of exemptions.
Yes, so there is a small business trust restructure rollover, which allows you to go from a sole trader to a trust without triggering capital gains tax.
Can that be a unit trust or a discretionary family trust?
Yes.
Okay.
You then...
That was a confident yes, was it?
Yes.
Check with your accountant, everyone.
Check with your accountant. Look, these type of things...
Sorry, it's the end of the episode. No one listens here.
Goodo.
Yeah.
It's a very complicated area.
Yeah.
So if you are in this space, then you need to be seeking advice because it's very specific. But generally, if you are moving from a sole trader to a trust, then you don't trigger the capital gains tax, which means that you roll over the cost base from those assets you had and put them into the trust, which defers the capital gain. So there's a few conditions though. There has to be no ultimate change in the underlying ownership. So the same family,
beneficial owner.
Yeah, the same family is still the sole trader is now the trust. The restructure is genuine and it's for commercial reasons. So there's you need to make sure everything you do has commercial reasons, and these assets in the business are actually active assets. But to answer Dave's question, yes, you will need a valuation because you need to help determine the market value of that stock. It's not the cost that you actually paid for it, it's the market value. And that could be goodwill as well, which needs to be transferred to the new structure. So yes, you need to definitely make sure you get a valuation.
But that could be
it doesn't need to be.
You don't
like
have to pay a value of $5,000. It can be just like, okay, here's the stock at value. We own some other equipment.
Maybe it's engaging a real estate agent. If you've got some property there, maybe it's 3 or 4 agents to get an idea of the value of the property.
But that's a broader discussion because we're not moving a property into a trust and trading out of the same. Anyway, but you vibe me.
You know what I mean.
Yep.
It's about, how do you come up with what's a reasonable market value?
Yeah, just so if you get a please explain in 5 years' time.
Exactly. You need to have the paperwork and you need to have it very well documented as to, well, how did we come up with this? And when you have those commercial reasons as to why you've done something, the paperwork needs to support it because effectively the onus is on you as the taxpayer to prove that this is why we did it. This is the reasons and this is the value.
Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.